Following the completion of the Australian reporting season recently, we thought it beneficial to provide you with an update as some of the things that we've learnt through that season. Australian equities is an important part of our overall investment strategy, not only for the direct equities that we hold within the MDA, but in addition to that, through some of the external funds that we invest in. The Access SRA9 is a good example of that, which has a core exposure to this market segment. In respect to the direct equity portfolios, we were quite pleased that there were no adverse company announcements which occurred during the period. Now, whilst we're not always going to be immune to not being invested in things which have a negative shock, we ultimately think that this is part and parcel of what we're trying to achieve in the portfolios. Namely, identify and invest in securities which we consider franchise companies. That is, companies which have a very stable and predictable cash flow stream. Ultimately, over the medium to long term, a company's value will reflect the amount of cash that it generates. Therefore, what we're trying to do is invest in companies where we have a great deal of confidence that on a 3 to 5 year time frame, the company is almost guaranteed to be generating more cash than it is today. As a result of this, it makes the portfolio far more immune to short-term exogenous or economic shocks. It doesn't mean that the share prices might not fall at times, but it means that through the cycle, we can be confident that the share prices will continue to appreciate as those cash flows come to fruition. So if we spend some time now talking about the specific themes or issues that we learnt from the reporting season, there are two which come to mind. The first is the strength of the resource sector, and the second is the weakness of the Australian consumer. And this is what the markets continues to talk about as a two-tiered economy that exists within Australia at the moment. So firstly, let's spend some time talking about the resource sector. The resource sector has benefited from materially higher commodity prices. At present, commodity prices are at or near their all-time highs. Now, with the volume growth that these companies have experienced and these prices sitting at all-time highs has resulted in very, very material profits being generated by these companies. BHP is a prime example of this, having reported a 10.5 billion headline profit for the half, which is up 72% on the previous corresponding period. Iron ore has been a primary driver for BHP, and the demand from China has been maintained. Ultimately, over the long term, and the companies themselves have been enunciating this, we expect that the iron ore prices will have to come back to around levels which far more reflect the marginal cost of production. At present, for these companies, the marginal cost of production sits around the $60 to $70 a tonne versus current market prices, which are close to $200. As a result, it means that the current market prices aren't sustainable. However, we remain very, very comfortable that in the short term, the potential for supply to come into the market and lower these prices is limited. Therefore, these resource companies shall continue to generate these massive excess profits above their cost of capital. The second key theme to have come through the reporting season is the weakness of the Australian consumer. Categorically, or across the board, we saw retail companies report the impact that this weakening consumer segment has had on their profitability. This has primarily been driven by the interest rate rises that we saw through 2010, as well as the general cost of living increases as utility bills are up 5 to 6%, typically across most states. However, the other factor is the strength of the Australian dollar, which is completely the benefit of this resource sector that we just spoke about. As the strengthening Australian dollar has increased, it's meant that a lot of the goods that these retailers have been able to sell have been far cheaper. So these retailers have been having to deal with price deflation as a result. Now, with an already weak consumer and price deflation, it means the only ability they have to generate additional profits is through increases in volume, which typically a very, very difficult thing to achieve in that sort of environment. In terms of the outlook for the consumer, we remain extremely cautious. We think that they're going to continue to struggle whilst the terms of trade continue to be so high. The terms of trade actually just reflect the price that we're receiving for the exports relative to the price we're paying for imported goods. What this basically means for the consumer is they're going to get very little support, be it from the government or the Reserve Bank, who continue to try and dampen the strength of the economy that continues to benefit from the resource boom. However, for an already struggling consumer, it means that there's very little benefit to come to them from other sources. In addition to that, we think one of the things that could proliferate through 2011 is the increase in oil price, leading to a material increase in fuel prices in Australia. The Australian consumer has genuinely benefited through 2010 from a relatively stable fuel price, which has resulted from the strength of the Australian dollar. However, if the oil price continues to appreciate or it stays at current levels and the Australian dollar weakens materially, then we can see very easily that an additional 10 to 15 cents could be added to the current fuel price. And this, in essence, will have a very material impact on sentiment for the Australian consumer. In terms of where our consumer investments currently sit, we're currently exposed to Woolworths and Wesfarmers as our two primary investments. Now, both Woolworths and Wesfarmers, which owns the Coles brand, primarily exposed to the consumer staples part of the market, not the consumer discretionary. As a result, both of these companies are very, very well positioned and have excellent management teams in place to continue to drive volume growth irrespective of this price deflation. And this is certainly something that we saw through recent results. Whilst Coles is a long way behind Woolworths, only having a much smaller percentage of sales per square metre, its current management team that has come in since it's been under the guidance of Wesfarmers has started to drive this materially higher, and we continue to expect to see improvements coming out of that business in the coming years. The smaller part of their business that is exposed to the consumer discretionary, be it Kmart, Big W, will continue to be under pressure, but ultimately this is a much smaller part of the overall business segment. So let's focus on a couple of other stock-specific issues in the portfolio. The first one I wanted to talk about was Queensland Rail, which was privatised or floated by the Queensland Government late in 2010. Queensland Rail basically generates revenue from two primary sources. The first is from haulage of coal in New South Wales and Queensland, and the second is by the maintenance of the Queensland broader rail network. At its first results announcement last month, the company basically provided two key elements of updates. The first was the impact on the Queensland floods. The Queensland floods basically limited the capacity to haul coal for an extended period of time, and as a result of that, the company is expected to generate a one-off lower amount of haulage revenue than would otherwise have been the case. But it's very easy, given this is a one-off issue, to look through this and look at the underlying dynamics that are going on within the company. And to this end, the company is doing an incredible job of pulling out costs that weren't in the prospectus numbers. And this is actually the key reason we bought the stock, so it's very, very pleasing to see this come to fruition. Now, the current stock price has already responded to a lot of this, and the current price, we'd say, is broadly fair value. But at the end of the day, we're still comfortable holders, pending other opportunities being available in the marketplace. Should these costs continue to be rationalised, we expect that the share price will continue to experience appropriate gains in the coming years. Another interesting surprise for us was the Australian banking sector, where banks reported increased profitability relative to our expectations. This is in contrast to the amount of noise that the banking sector has been making in recent times around the cost of wholesale funding, basically their costs of financing, and how that's impacting their profitability. What was interesting to see in the recent reporting season, by and large across all the major banks, was the increase in their net interest margin. Now, the net interest margin is basically the difference between what it costs them to borrow money at and what it costs them to lend at. Now, whilst over the medium term, we've been always comfortable that the banks were going to be able to pass through these increased costs, it was pleasing to see that in the short term they've already started to regain some of that profitability. And finally, I thought I'd talk about our focus on the energy sector at the moment in the portfolios. Structurally, we remain quite favourably disposed to the energy sector as a thematic, given the underlying demand that energy ultimately will have, especially with a very, very strong increase in demand coming out of Asia. The two companies that we currently hold in the portfolio, which will be the primary beneficiaries of this, are Origin and Santos. However, the importance of talking about these companies, or this theme, also is important to reflect on the amount of risk around it. Both of these companies have very, very large natural reserves sitting within Queensland, and in particular within coal seam gas, which has the capacity to generate massive future profits for them. However, the risk in generating these profits comes down to the ability to spend billions and billions of dollars in the development of facilities that will allow the extraction and export of this gas. So it's important to realise that as we focus on the opportunity in the portfolios, similarly we spend a lot of time focusing on the risk and ensuring that at any time we're purchasing a security, that risk is allowed for in the share price. Finally, looking out into 2011, we expect that the market's going to continue to be driven by geopolitical or specific economic events. At the moment, we think the market is slightly under, if not fairly valued, and there's a lot of potential upside for the companies in our portfolio. However, should these economic events occur, then ultimately they have the ability to drive short-term share price. However, given our theme or our desire to always own companies which over the medium to longer term are likely to generate more cash than they are today, then we remain very comfortable that as these small economic events occur, that these share prices will rebound over time and generate a net positive return for our investors.